I understand from the organizers that all of you here today are from internal audit departments of Islamic financial institutions. So I assume you are all experts in Islamic finance. So I'm here today to talk about the accounting standards that govern the Islamic financial institutions, not so much about the banking side. So when I prepared the slides, I forgot what was the topic given, so I just put MFRS and IFRS. Okay. A bit of what we will discuss in the next hour or so. Okay, thank you. I will start off with what is financial reporting. Okay, and then a bit on how you would go about doing that for an Islamic financial institution. As you would probably know, in the world, there are basically two main sets of standards that govern the Islamic transactions. A company would either use the IFRS, International Financial Reporting Standards, or in Malaysia, we adopt it as the Malaysian Financial Reporting Standards. Or there are some institutions in other countries which would use financial accounting standards prepared by the AOFI, Accounting and Auditing Organization for Islamic Financial Institutions. And after that, going through some of the conceptual differences and similarities, I will give a comparison, a worked example of Baik Bitam and Ajil and Al-Ijarah Muntahiyah Bitamlik, just to show you how it affects the bottom line figures. Okay, and then we'll take a short look on what does Sharia experts or Sharia boards have to say about which standards are more suitable and should be applied. And then we'll go and see about who is adopting which standards in which country. And just a small note for internal auditors at the end. So without further ado, what is financial reporting? I'm sure during your training or during your education, you would have encountered some auditing module, accounting module. Of course, you would have done auditing. Accounting module. So you would know that financial reporting is the process of providing financial information to make useful economic decisions. The key words here is financial information to make economic decisions. Okay? And you would know that the financial report normally comprises four main components. Your statement of financial position, we call it now. It used to be called a balance sheet, but this is the term that we're using currently. The income statement, or the profit and loss account. It used to be called profit and loss account because you were just concentrating on what was the net profit, but now there's something called other comprehensive income. So that whole set of statement is now called the income statement. Then, of course, very important to banks, your cash flow statement. And finally, the notes, the additional information about the financial statements. And financial reporting is concerned with four main things: recognition, measurement, presentation, and disclosure. So this is what we standard setters are always concerned about. Recognition is when do you report an item in the financial statements. Measurement is how much is booked in. Presentation is where you are presented, on which of the statements. And disclosure is providing more information about that transaction or item. Okay, so these are what is financial reporting from a secular view. Now, why do I say that? Because you note that from a secular or conventional point of view, you are concerned with financial information for making economic decisions. But there is a view of thought that Muslims or financial reporting from an Islamic point of view should encompass more than just the financials, more than just dollars and cents or ringgits and cents. This is quoted by in quite a famous book by a Malaysian academician. Islamic financial reports should communicate a company's social impact, not just the economic impact of that company, just the social impact as well. So if you read books on what we call Islamic accounting, you would see there is a tendency to try to incorporate other aspects of reporting, such as corporate social responsibility reporting, environmental reporting, and all these other non-financial information But the truth of the matter is, I think most Islamic banks do not do that. I don't think you prepare environmental reports or whatever, right? You may have some CSR or corporate governance statement or that. So the owl fee has also taken up on this idea, and it has issued, in addition to accounting and auditing standards, it also issues standards on governance standards, and also ethical standards as well. So this is something very different from most financial reporting standard setters, like at MASB. We mainly look at the finances, but ALFI has extended its scope to go beyond accounting and auditing, and they also look at Sharia and governance and ethics as well. And also I think there's a few other types of standards in the pipelines. So the most important for you all to know is governance standard number 7, which is corporate social responsibility conduct and disclosures for IFIs. And they also have a code of ethics for accountants and auditors and for the employees of the bank. Now in Malaysia, ALFI standards are not enforced, they are not mandatory. But I think there are some banks that do incorporate elements of ALFI standards into their internal processes. So I don't know whether your banks adopt their code of ethics for your internal processes, and whether you prepare corporate social responsibility reports or not. Some do, some don't, I think, in Malaysia. Okay, and of course, concerns about social responsibility and environment is not just unique to the Muslim population or to Islam. It's also similar developments elsewhere in the secular sphere, as I call it. And you will find that there are other standards issued by bodies such as the Global Reporting Initiative. There are also efforts by the UN. There's the UN Global Compact. And more recently, there has been established an International Integrated Reporting Council. So now this council is made up of several international and supranatural bodies, and their idea is, again, to extend corporate reporting beyond just the financials. They call it integrated reporting. I think about last month, I think in April, they issued a draft framework, which they are inviting the public to comment on. So if that is something that your entity, your bank is interested in, you have until 15th July to submit a comment. Okay, we are not sure of how far Malaysia will be adopting this, but that is something to look out for in the future. Currently it's just a draft, okay, but it's interesting if you are interested in this field. Okay, so back to financial reporting standards. Like I said before, I'm from the Malaysian Accounting Standards Board, so we do not really look at these other types of reporting other than the financials. And with regards the financials, like I said before, there are two types of standards which would apply to Islamic banks. The first one would be the International Financial Reporting Standards, or better known as IFRS, which is issued by the International Accounting Standards Board. It's based in London, but it is an international body. Its board members comprise members from various parts of the world. So there's a fair geographical representation on its board. And it is used in over 120 countries. That means the accounting standard setters in more than 120 countries have adopted IFRS as their national standards, including Malaysia. And that's why you have the Malaysian Financial Reporting Standards, which is an adoption of the IFRS. And in the past few years, there has been criticism that the ISB or IFRSs had been ignoring Islamic finance transactions. If you have any accounting experience, you would know it deals with mainly, how shall we say, conventional products, and not much on discussion on how it would be applied to Islamic transactions. So recently, in 2012, the ISB established a consultative group on Sharia-related matters. I'm happy to say that Malaysia is very active in, well, it's a new group, so, but we were active in promoting and pushing for this group to be formed. And I'm happy to say that we have been invited as a member, okay, to join this consultative group. So that is one way for us as Malaysians and Malaysian constituents to let our concerns or issues be channeled right up to the ISB. Okay? And of course, there is the AOFI, which was established in 1990. It's based in Bahrain. And its standards mostly are catered for IFIs for use in Bahrain, Sudan, Oman, Qatar, Jordan, Yemen, Syria, and Lebanon. So it's mainly limited to that geographical area and also to the type of banking that they use. If you have actually seen the AOFI financial accounting standards, you would see that the way they describe some of the transactions may not be how it is conducted in here in Malaysia. Okay, so there's some reasons why when people ask us why is it that AOFI standards are not adopted in Malaysia, that is my short explanation. Because they are catered for certain transactions which are conducted in a certain way, as it's done in the Middle East, but not necessarily the way it's done in Malaysia. Okay, and the reason is because those transactions there reflect the decisions of their AOFI Sharia board and not necessarily the decisions by our Sharia boards here or even our Sharia Advisory Council. So that's a short explanation. We'll explain that in detail in later slides. Okay. So how do you report an Islamic financial transaction? Okay, I'll let people take their seats first. There are seats up here. Okay, maybe we'll just rewind a bit for the newcomers. Basically, we were explaining about the two sets of standards that would govern Islamic financial reporting, the IFRSs in Malaysia and in 120 other countries, and AOFI, which is mainly used in the Middle East, okay, and not adopted in Malaysia. So we are going now into how do you report an Islamic financial transaction. First, we'll go through the conceptual concepts first, before going into our worked example, okay? Okay, as you know, Islamic financial transactions take a different contractual form from conventional banking transactions. But in a lot of cases, they are economically similar. So for example, if you wanted to safeguard your money, in a conventional contract, you would place a deposit and earn interest. But in the Islamic sphere, you would entrust your money or put a wadiah contract with the bank, and you may or may not receive gift or hibah. But in Malaysia, of course, you would, because you would have a flight away. Okay, and similarly, to protect against adverse events, conventionally you could buy insurance, which is a buy and sell contract, or in the Islamic sphere, you would enter into a takaful arrangement, where you and other individuals would pool your monies together for mutual indemnity, to mutually indemnify each other against an adverse event. And to finance a purchase or an operation, conventionally you would just go to a bank and borrow, pay interest on that amount borrowed. But of course, in the Islamic sphere, you would have to have a Sharia approved contract, such as murabaha, you buy at a markup, and that profit may or may not correlate or correspond with an interest rate. Or you may have mudarabah, get a partner to contribute capital. In some cases, as you know, this would be like treated as a similar mudarabah financing, but in some cases, some banks here treat it as a joint venture. There are many ways of accounting for it, as we'll show later, okay? And the more sophisticated now, going into derivative-like arrangements, where you can exchange a variable cash flow for a fixed cash flow and vice versa. through contracts known as commodity murabaha. So instead of a normal swap transaction conventionally, you would have something called commodity murabaha, where you buy and sell reference commodity, and the prices of those buy and sell would be similar to an exchange of a variable rate instrument for a fixed rate one. Okay, but it's not always the case that the economic effects are the same. For example, in Mudarabah Musyarakah financing that I mentioned earlier, it could be the case that under accounting standards, when you look through the contracts, it may not be accounted for as a normal bank loan. It could hit or trigger the criteria to be accounted for as a subsidiary or associate or joint venture of the bank with that customer. It may be the case. So far, we have not seen any real-life examples, but in theory, it could be the case that it's not a financial instrument or an asset to the bank, but some other interest in another entity. And then Mudarabah and Musyarakah customer accounts. Currently, we are, I think, treating them as deposits. But moving forward, as you all know, Bank Negara has issued a consultative paper on investment accounts. So moving forward, would those still be considered as deposits? And then if they are not deposits, are these items to be on balance sheet or off balance sheet? Okay. And then ijara. Currently in Malaysia, I think most banks would account for it as similar to finance leases. But you have the opposite point of view in the Middle East, where all ijara would be accounted for as operating leases. But regardless of these two standards, there are issues with how do you account for a lessee right of use and a lessor's ownership minus the right of use. We'll discuss that later. Okay. And takaful, is it insurance? Should it be subject to the IFRS on insurance contracts? Okay. And do you need to consolidate it with the takaful operator? The funds of the takaful policy, the participants, should it be consolidated with the assets and liabilities of the operator? And how would you measure a card? If you are not familiar with takaful, in conventional insurance, if the fund has a deficit, the insurer is liable to make good that deficit. But in takaful, because it is deemed to be separate entities, the funds pool is belonging to the participants, is separate from the operator. If there is deficit, technically, the participants should bear it, but due to consumer protection laws, takaful operators in Malaysia are required to extend financial assistance through a card. So how would you account for that card? Okay, because it's not really like a loan, even though contractually it is. Okay. And then, of course, derivatives, because like I said earlier, because you use these commodity murabaha transactions to mimic a derivative, should they be considered as buy and sell transactions, or are they a single link transactions? And we'll explain later what is a link transaction in accounting. Okay. Basically, all these issues can be summed up into these concerns: substance over form, time value of money, recognition based on a probable future economic benefit, link transactions. These are the main issues that need to be answered when you are looking at your Islamic finance transactions. And of course, other things such as presentation and disclosure of the Sharia contract. I think in Malaysia, Bank Negara requires you to present what contract was used. So if you see on the face of your financial statements, they would actually say, income from ijara or BBA or like that. But that is not the case elsewhere in the world. So while HSBC Hamana may show how much income is from ijara or whatever contract, if you look at HSBC PLC, all that information would disappear upon consolidation because it's not required in other jurisdictions. Financial reporting boundaries, like we said before, we are still just concerned with the financial report currently. Should we extend that into other areas? Corporate social responsibility, environmental reporting, and all these other areas. Where should the boundaries be? Okay, because in the conventional sphere, I think it's conventionally we've only dealt just with finance, but if you say Islamic accounting deals with other things, should we extend the extent of your reports? Would your annual reports get thicker? Would your scope of audit be increased? Okay, and then of course terminology. If you read through the IFRSs, everything refers to interest rates and interest rate methods and all that, which may not be very congenial towards Islamic finance, but we'll explain why that is not so much of an issue, because the ISB has already declared that they don't really mind what you call it as long as the measurement basis is in compliance with the IFRSs. Okay? And of course, like I said before, because some banks or some countries use IFRS while others use AUFI, we do have a problem with cross-border comparability. If you are an investor and you want to invest in Bank A in Malaysia and Bank B in Bahrain, you'll be presented with financial reports which are prepared under totally different basis. Okay, so how do we improve cross-border comparability? And of course, you have to consider IFRS convergence. In Malaysia, I think we've already made our stand. We do use IFRS. This is a problem in the Middle East. So if you are working for a Middle Eastern bank, doing your overseas reporting or the head office reporting, you will still have to be holding two sets of financial statements, IFRS and then AUFI statements for your head office. So this is also a problem. And also we need to have more stakeholder engagements. I think a lot of people do not understand financial reporting, and especially since the IFRSs are getting much more complex, especially the IFRSs on financial instruments, which is IAS 39 and IFRS 9. So I think there should be more stakeholder engagements to allow people a chance to understand. And this is especially true for Sharia advisors and educators, where their exposure to financial reporting and finance may not be as much as all of you here today. Okay? So substance over form, what is it? Basically, in financial reporting, we have this concept that a transaction, the economic outcome of a transaction may not necessarily follow its legal form. Okay, now I give an example. In legal form, a transaction may take the form of buy or a sale. Okay, and you add to that a profit element for the deferred payment, and you may have a clause or an understanding, because I understand you can't put it in the contract, for an IBRA in case of early settlement or default. So in legal form, it's a sale, but because you have all these other elements attached to it, in economic substance, what you would have is financing. Okay, so the dilemma is, for people in Islamic finance, is whether do you put that in the financial statements as a legal form, as a sale, or do you put it as financing, which would follow the economic substance? In IFRS and MFRS, we've already settled that by saying that economic substance prevails over form. That's what we mean when we say substance over form. You would record that in your financial statements as a financing transaction, even though it takes the form of a sale contract. Under AUFI standards, that is not necessarily the case, okay? Because they have this different view, and well, classically they were silent on whether substance or form should prevail for measurement purposes. Okay, so you will see some of their older standards where they would report based on the form. They would report a sale, like you would sell tables and chairs. But their newer standards are sort of moving away from that. So they have a mix of both. Okay. And then the second most important concept in financial reporting is the concept of time value of money. If any of you have taken finance papers before, you would know what this is. But for those of you who haven't, just a recap. It is the assumption that a rational person would prefer to have a unit of money today rather than tomorrow. If I said I want to give you RM1, you want it today or next week? Of course you want it today. You can do more things with it today rather than next week. So in accounting, when we take this into consideration, how you would report a cash flow would be different. So quick example there of undiscounted cash flow and a discounted cash flow to take into consideration the time value of money. So under IFRS and MFRS in Malaysia here, this concept is fundamental to how you report or you measure your items, especially financial instruments.